Okay, good evening, everyone. Well, we're very excited. It's 7 p.m. on the nose, and we are very excited tonight to be doing another Let's Talk Property scenario. And tonight our guest is Richard Dunn. He's from Skyward Property Solutions. We will go a little bit into what Richard, where his background is and how he can assist. Really, at the moment, a lot of people are asking myself and my team questions like, what is happening in Australia? Is it a housing bubble? Are there strong fundamentals? Should I be investing in it? Or, is it something that I should be avoiding at the moment? And what we really believe in what I've certainly experienced in the last 3 years when it comes to property, we've had the global financial crisis. We've seen some markets rise. We've seen other markets fall. But I think the most important thing that you need to take into account is that you need to be able to listen to educated people so that you can make educated and informed decisions yourself. You need to understand what those fundamentals are. You need to understand the science of what is actually going on, because most importantly, you don't want to be swept up in emotion. You need to understand what's going on. And that's why with Let's Talk Property, we're consistently looking at bringing the experts to the table. And Richard, are you there yet?
Yes, can you hear me?
We've got you loud and clear. So I'd like to welcome Richard on tonight, and I'd like to welcome everyone else on tonight. But Richard, awesome to have you online, and apologies for getting you up at 3 a.m. in the morning in Brisbane.
Yeah, no, as long as you can hear me okay, it's a pleasure to talk to you, as always. So hello everyone, good morning from Australia.
Cool, man, and thank you very much. And guys, if anyone wants to, please just post through questions. In the top right-hand corner, you'll see there's a little box there. And if you just fire through questions, we'll be able to answer them. The whole purpose of tonight is to keep this as interactive as possible and to get everyone in the zone. Now, just before we get into Richard and what it is that Richard does and how he can answer some of the questions that we sitting here on the other side of the ocean would like to know, I've got a quick couple of questions for you. And I'd like to see, you can't obviously raise your hand on a webinar, but just tell me if these questions actually, are true to you, or certainly something that you're thinking about. So I love South Africa, but I'm concerned about the future of South Africa with what Malema keeps saying. Is that something that rings true to you? Is that something that's a concern for you? What about saying that I'm not sure where to invest as there's a lot of uncertainty in the global markets? Is that something which rings true? Where is better to invest? South Africa, America, the UK, and Australia. Now again, tonight, we're not looking at those other areas. We're only focusing on Australia. But is that a question that's going through your head? And is that why you're on tonight, wanting to know what's happening in Australia? I'd like to have a plan B, but I'm not sure what to do. I'm concerned about the long-term value of the rand and preservation of my wealth. I've heard investing offshore is very difficult and more than 80% of people actually lose money. How do I trust who to listen to? I don't know the markets and so don't know where to start. I think I can get better returns in South Africa at the moment, but I know it's wise to not have all my eggs in one basket. How am I going to manage my property when they're so far away? And lastly, all I know is that to give me and my family peace of mind, I must do something. Now, do any of these questions ring true? Because these are the type of questions that I feel, when I think about where I am, where the future of South Africa is going, where I should be investing further offshore. And certainly I know with all our clients, these are the type of questions which are ringing true in their minds. Has anyone got any other questions, or is this something that really is ringing true for you? Is this why you're online tonight? And please, guys, the more interactive you are, the more we will be able to give as much value as possible. Has anyone got any thoughts on that? While we're waiting for some thoughts to come through, I want to introduce you to Richard. Richard and I met about 4 years ago. I've basically helped over 2,000 people invest in international property. We helped start with helping sell South African property, and for expats primarily in London, invest back into South Africa. Then we started helping people invest in London because we had offices in both South Africa and London, and we had experience in both markets. And then at the back end of 2007, I came back to South Africa, and I found for every 2 clients that I met, one wanted London and one wanted Australia. And the problem I had is I'd been to Australia for the Rugby World Cup in 2003, and it was a bloody big place. and I didn't know where to start. And so I flew over to Australia. I actually went over 3 times at the beginning of 2008. And it was actually Richard and one of his ex-colleagues, Phil Kelly, that came across me, funny enough, through a YouTube video I made. And I went over and had the pleasure of being taken around by Richard. And Richard showing me what was happening on the ground, teaching me the fundamentals, showing me why the market was like it was, what we had to focus on, what was good about the market, what was bad about the market. Because the one thing that I found in Australia is that Australian property salesmen are bloody good, and they will literally sell you absolutely anything. You know, I used to joke with people that you could literally get a property in Ayers Rock, and they said that you would, you know, be able to see Sydney Harbour. And I always struggled, you know, it's a huge place. I didn't understand the market. I'd never bought there myself. And that was really where I first got to meet Richard, so much so that we really, you know, over the last 4 years have become great mates, and I've really got to the point where I believe that he's one of the most sophisticated, educated property investors in the Australian market. So that's a bit of an introduction for you, Richard, but tell us a little bit about your background with regards to Ozinvest and now your new and very exciting venture, you know, with you moving and going on your own.
Yeah, thanks, Scott. Yeah, everyone, basically my background is in development construction. For the last sort of 4 or 5 years, I was the National Acquisitions Manager for Ozinvest, which was a very large organisation primarily focused on investment property. We were heavily focused on finding the best investments for the average Australians and people offshore. And my area of expertise was leading a team, finding the right opportunities throughout Australia. So my market knowledge was quite extensive, and in the last year, basically, we were working towards starting our own operation with several key people, and that's what we've done, and we'll continue to do the same thing, specialise in investment property for Australians and people offshore, all our friends offshore.
But I think, I mean, just to elaborate a bit on that as well, you know, with your experience, certainly over all the years you worked at Ozinvest and before that in the building industry, you're very in tune with what is happening within the market. And like in any market, there are ups and downs in any market. But if you're educated and informed, then you can take advantage of a market even in a down cycle, if I'm right in saying so, Richard.
Absolutely. And dealing with a lot of people who build portfolios of property over in Australia, that's exactly what they do. They basically, I mean, as you'd probably be aware, most people would be aware, there's highs and lows in any market, and we find our mainstream of investors are the sort of people that will be following those sort of down cycles, because that's a good time to be getting in when other people are unsure of things, especially if all the fundamentals are right.
Well, let's get straight into it, Richard. We've been asked a number of questions that have been sent through by different people, and I think the most pertinent one is, before we get into property, you know, where is the economy at the moment, the Australian economy? What are the risks in the economy? What do we need as investors to know about the Australian economy, and what's going on over there at the moment?
Yeah, sure. Look, I mean, I think it's quite clear we've got a fairly heavy reliance on China, and it's a bit of a narrow focus, and it can potentially work against us. There's an increased dependency on commodities, and it means commodity prices will be more destabilising, I think, for Australian economy than in the past, where we're heading with China. But just to give you an idea, there's how top heavy we are. There's 94 projects underway worth approximately $174 billion, and these are projects that have started in various locations throughout Australia. But it's nothing in comparison to the amount of projects that are being touted, and that could boost the mining industry by approximately another $800 billion. So that would mean our GDP is fairly top heavy there, based around the mining industry, and our GDP would be about 60% on the mining focus there. So we're very top heavy, but there's reforms underway to combat this, and including the mining tax, which I'm sure a lot of people have heard about, even in South Africa, which has caused some interesting reactions here in Australia. And there's also other ongoing tax reforms that will be directed at the average Australian. I mean, you're also seeing more public people saving in this sort of time, you know, not willy-nilly spending, going out and buying things as Australians like to do. That's certainly tightened up in the last year to 2 years, well, basically since the GFC, the first GFC. And it's just a question of where we're heading, really. I mean, you'll find Australia, when you look historically, Australia went into the GFC with a budget surplus. And allowed us to spend big on incentive packages when things weren't going so great. And you've probably heard of the first homeowners grant. That's one example that was very successful.
Tell us a little bit about that, please, Richard. So just to confirm, this was, you know, the whole world was going into the global financial crisis, and what did you guys do to stem the tide?
Yeah, well, basically, we understand that that our economy is driven fairly heavily by what happens within our local property market. So the government reacted with that deficit, that surplus that I mentioned, and they incentivised people to go out, especially the first homeowners. That was why it was called the first homeowners grant, and they would actually give people a grant, depending on where they were located, to go out and actually purchase their first property. So they would actually contribute up to sort of $25,000, $30,000 for a first homeowner. And you can imagine all this going on when the rest of the world is talking about doom and gloom, and yet the average Australian is going out there who's not bought a house, has gone out there to purchase a house. Now, just to give you some idea of how much of a success that was, there's 195,000 people, first homeowners, went out in that period and purchased their first home. So it's quite significant. And as you probably understand, that was to go out and build their first home, buy and build, because building stimulates the economy because you're employing builders, electricians, plumbers, and various host of other things. So it was a very successful campaign, as it turned out. But I think on top of that, Scott, it's important to note that that we're now in a bit of a deficit situation. So to answer your question, I guess, you know, we're still basically where we're located down there in Australia.
Richard, sorry, quick one. One of the gentlemen online, Chris, has said that you're coming through very soft. Is there any chance you could speak a bit closer to your microphone?
I'll try that.
You're fine on my side, but yeah, just if it can help.
Just tell me if that's any better. It might be a bit soft because it's 3 o'clock in the morning, Scott, and I'll probably wake the neighbours if I talk any louder. Yeah, please tell me if you can't hear me, of course. Look, I think, you know, there's some fundamentals that are in our favour. We've got a very low unemployment as well. And the average wage in Australia and disposable income is rising despite the sort of things you might hear. When you look at all the facts and figures, and that's very important, and I'm sure we're going to touch on that later on. And you're finding that household budgets are healthy, as many people are, as I touched on before, more people are saving and investing actually rather than spending. And we've just done our latest census here in Australia, excuse me, and we've all had to do it, of course, so that's going to be interesting when they release all the data later on this year. But and the other factors too, the interest rates are high enough to be reduced by probably 2 or 3% if needed to prevent a recession if things get really tough, and that's basically what happened last time in the GFC. So yeah, there's some risks there.
I mean, just to reiterate what you said there, Richard, because I think it's very important, and I don't want it to be missed. In places like America and England, you know, their interest rates are at a 300-year low, and if things get tough, there's nothing they can do. Whereas Australia was the first country in the G20 to put up the interest rates after the global financial crisis, and subsequently have actually put them up 8 times. And they're now in the long-term band between the 30-year band between 7 and 8%. But what you're saying is that if more trouble was to come, there's plenty of scope to be able to drop them back to 3%, which is where they dropped them to in the global financial crisis.
Yeah, absolutely. And there's been plenty of talk of that. I mean, of course, that's not something they want to entertain at the moment. But no, the point is there's scope to do that. We're well placed, you to certainly go down that track if need be.
Now tell me, I mean, in terms of the market, the housing market, we've spoken about a couple of the risks in the economy and where it is, but what are the risks in the housing market, Richard, as an investor? What should I be aware of? What is happening basically?
Look, I think what's happening currently is, to put it in a nutshell for you, we're having a correction, there's no question about that. But you'll find the fundamentals are very different, if that's the right word, in Australia. I mean, just firstly on that, Scott, in the past, I guess every time there's been a stock market crash in our history, investors quickly move into the sort of tangible assets like property and gold and silver. But the bottom line at the moment is that I guess after initial correction, which we're going through, or lull in our activity, if you follow our historic patterns, it's common to see several years of sort of this correction, if you like. People talk about this potential bubble, but just to break that down a little bit, we've had such tremendous growth in some areas, and the Gold Coast, if everyone's familiar with the Gold Coast in Queensland, is probably a good example, where over the last 10 years you had significant house price growth of over 200%, and that's really become a sort of a mecca for the top end of the market. So you're sort of $1 million, $2 million purchases now, and of course in a time of correction and uncertainty like now, that's the market that really gets affected. And if you're talking about bubbles and so forth, well, bubble's probably not the right word to use, to be honest with you, with the top end. It's a correction, and you're going to see losses or corrections in that top end. That's just a fact. But our real market is in the mass market of Australia, which is this sort of mum and dad type Australians with 2 children. That's a typical demographic, and they're the sort of people that there's such a large percentage of our market, 75%, that they basically drive our market, and they're not the $1 million and $2 million buyers. They're the sort of more $300,000 to sort of $500,000 and $600,000 buyers, and they've got the income to sort of sustain that. So that's our real property market. To answer you, and I'm not sure if I'm answering the question, but bubble is not the word that we use here in Australia. A lot of economists and certain people in media like to use that term when they see the Gold Coast market or the Sunshine Coast up here in Queensland going the same way. But it's very, very important to remember our fundamentals or our demographics here. It's more the top end, most definitely, is sort of coming back to a correction now. And we're talking about corrections of probably 10%, 20% in some cases. But your average property market or your mum and dad type market is still moving. It's still moving along. Yes, that's slowed as well, but you're not seeing big reductions in that sort of $300,000 to $600,000 price bracket. You're just seeing a lull, basically, a correction. And I believe, and when you talk to many sort of property commentators here and economists, that market is under such pressure to produce more housing in that market, that you're going to find that's probably going to hum along like it always has done historically through all these sort of world dramas and wars and so forth. So no, I don't think it's going to be a bubble at all, and many people would agree with me there. But you'll certainly hear it from the media. They like to sort of, like anybody's media, your media is very much like that, I believe, as well, Scott.
But I mean, just to reiterate that, and 100%, the whole purpose of tonight is that we don't want to get caught up in the sensationalism of the media, and we actually want to know the facts and figures and what is actually happening. I mean, so just to confirm then, what one needs to be careful of is it tends to be sort of lifestyle property. When you mention the Gold Coast and the Sunshine Coast, I mean, that's holiday property. It's, like a Belito or the South Coast of Natal or the Garden Route. And then it's also the top end that really, has taken a lot of strain with rising interest rates, et cetera, et cetera. What are the fundamentals? You've spoken quite a few times about these fundamentals, the mom and the pops, the middle market Tell us a little bit more about that. What is it that I need to know as an investor with regards to these fundamentals?
Yeah, look, I think basically it's a common fact here, certainly in our industry, that Australia does have a clear housing shortage in relation to our population growth in that mass market I was talking about. That's been well documented. There's government websites, and when we get a chance a little bit later, I'll bring one up on my screen there, Scott. But a housing shortage in that market is very clear. It's been clear for a very long time, and the government's introducing new incentives to fill the gap there. And like NRAS, the National Rental Affordability Scheme, they've aimed to produce another 52,000. This is the government is incentivizing investors to produce another 53,000 houses by the year 2013 in a lot of locations that they've highlighted after much research, and that's a government-backed scheme, and they wouldn't produce. They wouldn't put so much emphasis on this if they didn't believe there was a shortfall. And I guess people like myself, which are embedded in the market, you see this all the time, and in that mass market area I was talking about. And and again, I'm very lightly touching on this, but you combine this with your very clear skills shortage that we have in Australia here, which has a big effect. And of course our growing population, it's a nice steady growth. We've got a good immigration policy, and we grow by approximately sort of 300,000 people every year. And it's a very selective immigration policy as well, which is only going to be good for our economy down the track. And historically, you look at the situations that Australia has weathered basically in the past. And we've certainly had those major corrections I was talking about. We've had all the effects that everybody else has had. We might be far away, but we're not at the end of the earth here. We certainly feel the effects, but we deal with them correctly in the right way, from what I've certainly seen measured against other economies in the world. So our fundamentals are strong, Scott, and they continue to be. And I think that you'll find what's happening at the moment is there's many Australian investors coming out looking for the right investment in certain locations around Australia.
Can I just show you some stats here, because I think it's pretty important, in terms of where we are and everything that you're mentioning, because it just sort of highlights what you're saying basically. So let me just pull up my screen here quickly. Just starting off with the economy, basically, you showed in terms of what was happening with Australia, and just in terms of the real GDP, Australia never actually went into decline, whereas all the other major economies did. And then this was what actually happened with the Australian property market in comparison with the UK and the US. And just in terms of some of the fundamentals, this RP data, I've got the up-to-date report, which I want to show you in terms of what is actually happening and the values. But this is also and I know these stats are a little bit outdated, and I'm not sure, Richard, if you've got more up-to-date stats, but this was just showing the difference between the supply and demand and what you were actually talking about.
Yeah, look, it's very clear, and the way one of our biggest crises here is producing enough housing in the areas of need, and it's important to take anything away from this meeting is those demographics I was talking about. Our issues are with the top end, the prices are correcting themselves, but in the mass market, that is where which is the largest part of our housing market, this is where you're seeing this massive shortfall, and we simply can't build enough homes in the right locations around the major cities and towns and mining towns and all that those sorts of areas to keep up with the demand that is required. So that's a very key thing just to take away from here. But I've got the latest. I don't know if you can get onto my screen, Scott, but I've got the latest.
No, perfect. If we can swap over, that'd be awesome. So I'm just putting up the graph there from the latest. It's not the latest, but the last stats I had on the supply and demand, and showing how much out of kilter they actually were. Let me change over to yourself, and you'll be able to show us what you got on your screen. Just while we're changing over there, there's a question come through from Christian who says, is NRAS in every state as a government scheme or only in certain states? What does it offer to the investors, like a rental guarantee of sorts or benefit after each year, or how does it work basically?
Yeah, NRAS basically is a government-backed organisation, as I said before. Developers and builders around Australia have to apply to NRAS when they have an opening, when they have a certain round of allocation. So you're basically getting, as a government organisation, get inundated with potential projects that may meet the criteria that's set out by the government, and it's basically to produce for Australian developers and builders to produce affordable housing, and it's got to fit, as I said, a certain criteria. And yeah, they're incentivising investors. Basically, they're going to incentivise an investor. They're going to give them an extra 10,000 Australian dollars every year, approximately, and that will obviously increase CPI every year to do this. And it's quite a huge thing, because they're thinking all the time, well, how are we going to get people? Our real problems are producing more housing. So how are we going to get our own people to go out there and invest into housing which Australians can rent, because Australia is a nation of renters, which is different to what you're probably used to there. But yeah, it's a pretty big thing here, and it's here to stay for a long period of time, and it's in key locations, to answer the question, and that's the government's criteria. They'll look at cities like Sydney, for example, and they'll go, well, look, the median house price is $550,000. There's not enough housing below this market, so we want to see projects that have come through that are below that, in the 400 to 450,000, if that's possible, or whatever their criteria is for that state, and then they'll endorse it. They'll NRAS endorse it and back it with their government scheme. So the other part of that scheme too is that for 10 years they will guarantee that 80% of the rent, and the investor has to be able to wear the shortfall. There's a couple of obviously issues, but I can certainly go into more details with that. But overall, it's very positive, and it's a good incentive for Australian investors. It's got a lot of, and overseas investors as well. It's got a lot of tax incentives as well. So I guess the point I'm trying to make is that we are seeing things a little bit differently here. Our own issues internally are to produce more housing in that market. So I'm kind of hoping that's answered your question. But can you see my screen up here, Scott?
Yeah, no, we got your screen clearly. So just to confirm then, NRAS is basically a government-backed scheme, because in complete comparison to somewhere like an Ireland or an America or Dubai, there's still a huge problem with supply versus demand, and particularly in the affordable entry-level homes and accommodation and everything else. And so the government has created something like NRAS to be able to try and incentivize investors to create more rental stock. Is that, you know, is that a good enough summation?
More investment housing, that's right, in that sort of, to help that sort of mass market, if you like, that I touched on earlier. So yeah, that's very much it in a nutshell. Just excuse me because I'm still a little bit slow at 3 o'clock in the morning, but if you can see my screen here, RP data is what you were talking about before, Scott, and this is where you get a lot of our valuable information on where the market's heading. And as you can see up there, at the moment, compared to this time last year, we've had some corrections in the market of sort of 2%, I guess, across the board. You'll see Brisbane there sort of stands out at sort of 6%, but you'll find a lot of that has been because of the floods we had in January. That's a lot of the after effect of the flooding that we had in January. So of course that has a big effect on the marketplace. Brisbane's actually been highlighted as one of the most needy places to incentivize people to build houses, funnily enough. So that will correct itself, no doubt. But you'll see basically across the board in the last year, we've had some corrections there. So they're not dramatic, declines in property, and we're not expecting them to be either as an average. So this is the sort of information, I think. This is the latest for the quarter, for the second quarter of the first half of the year, and yeah, it's pretty fresh off the cab there. From
Just to confirm here, Richard, because I know RP Data is the one that you and I both use. They're an independent body, so they've got no emphasis on trying to make it look good or bad. They're completely independent, and I found it being the most valuable research portal for the last 4 years since we've been focusing on Australia.
Oh, absolutely, yeah. They're statistic based. I mean, they're not in favour of anybody. They just tell you the facts and based on the sales and so forth, and a whole lot of sophisticated information, and it's very valuable to see what's happening within the market. So yeah, I think it's quite interesting to show what's been happening there.
And also, Richard, just in my interest, where you know, looking at, like, say, Brisbane minus 6.3% there, surely that's had an impact with regards to what's happened on the Gold Coast and the Sunshine Coast versus, say, a property, you know, an affordable home in one of the suburbs.
Yeah, well, yeah, basically you're right, Scott. You know, you're talking about probably corrections, if you like, in places like the Gold Coast, where a $2 million apartment, a beautiful apartment overlooking the ocean there, you could probably pick up $500,000 less, you know, and there's lots of stories of those sorts of things going on at the moment because it's the top end. And I think you're going to see it that way for quite some time over the next sort of couple of years. So it's not a real reflection on the overall big picture of the Australian market, because that top end is very small in comparison to the actual largest part of this market. I'm sorry to harp on about that, but it's just something that I do like to emphasise, where our true market is. And if you don't mind, Scott, I'll just close that down. You know, there's some interesting articles floating around at the moment. You know,
just while you're pulling that up, for anyone that's interested, we can, you know, we've got that report, and just send me an email and I'll send you the latest report in terms of it. It's a fascinating article on where the market is at the moment and where it's going.
Yeah, basically, I mean, there's a lot of people giving facts, and I just thought this one was quite interesting as well when it comes to our own investors here in Australia. You look at the performance of shares and government over the last 10 years, you can see quite clearly how property has gone. There's our little blip in the market there with the GFC, and this is where we're at sort of at this part of the year. So, but over 10 years, and I think it's important, and it may be very similar in South Africa, but it's certainly the way here in Australia. People understand property. They know historically how property performs. You know, and it goes back well beyond 10 years. We're talking until they started taking data in Australia, and you'll see that historically property in Australia over time, no matter what, no matter if it's been the First World War, the Second World War, global meltdowns, dot-com crisis, we've weathered that storm, and over time, and this is where investors should look at it, is the long term. Over a 10-year period like this, you find your properties have normally doubled in value consistently. And it's weathering those sort of lulls, if you like, and riding the upswing. So it's a long-term investment. And that's what Australians can see. They can understand it. Whereas shares and so forth, you need a little bit more help. Well, certainly I do. But I just thought that was an interesting one to bring out. Other bits of things in the market at the moment. This is the thing that we're seeing a little bit of. They're skyrocketing because less people are probably buying, and there's more renters out there. You know, so you're finding that this is what's happening with the negative side of the market. People are moving into renting properties. So for investors, it's a fantastic thing, you know, to see sort of articles across the.
Richard, just a quick one there. I mean, probably the biggest lesson I've learned from the last 3 years with the global financial crisis is that those people that focus on income are the people that have done the best and can ride the different market cycles better than, people are focused purely on the capital growth side. Tell us a little bit about the demand. I mean, you've got the article up here, but what is the demand like for renting? I mean, what was it like for you in Brisbane with the floods as an example, and what is the vacancies across the city centres, etc., just so we South Africans can understand it.
Well, just to give you an idea, there's always been a shortage of good rental accommodation being built and ongoing in Australia. Now, when the floods hit in January, I was right in amongst it, as you know, Scott. So I had to move out of my house because my house got flooded. And every property I went to, even though I'm in the industry, you'd have queues of people going on any given day. And you're talking about, on top of already the shortage that was there before the floods, there's another 20,000 homes that were affected. Now, everybody appreciates it. It takes 9 to 10 months to get a house built in any city in Australia. So you had this issue already that was there, and just with another 20,000 homes being that were going to need repair or demolishing or whatever, that's put a lot of pressure. And you're still seeing that now in Brisbane. That's why I say you watch Brisbane in the future. There's a lot of opportunity there, despite what people are saying. I've been in it myself. I've seen it firsthand. I know many people many top people in the industry are saying the same sort of thing. In the right locations of any city in Australia, there is major demand for good rental property, and you're seeing a few of that sort of filter through in some of the adverts and some of the papers and so forth.
What are some of those that vacancy? I mean, am I right in saying they're generally less than sort of 2%?
Yeah, you're pretty much finding that. I don't know. I haven't got the here at the moment, but a very low vacancy rate of, depending on the, and I can give you statistics to you, of sort of 2, 3, and 4%, which is very low. When you look at it, for every 100, and they may be in between getting new tenants, the old tenants moving out and the new tenants moving in. So in these key locations, there is great demand, and that's what's driving a lot of our investors to be coming back into the market currently. So yeah, Brisbane certainly has got a very, very good story on why things are heading up there. There's articles about auctions and so forth filling up, and this particular one was in Melbourne, and that's always a good sign too, to see people out there filling up auction, standing there obviously, as they do probably in South Africa, but you get a very good gauge of the market and what's happening when you're seeing 20 and 30 people down the street or outside a property that's being auctioned.
Just to butt in there, Richard, it is a little bit different in South Africa because we don't get the not sure if we lost you there, but we don't get auctions like you guys get. Something like 70% of all properties in Australia are sold by auction. Residential properties are sold by auction. So just to put in perspective, so it is a very good gauge that the Australians use as to the demand within the market.
Yeah, absolutely. I mean, it's certainly a very big part of it. It's a gauge we'll look at as well. So you're seeing that in the major capital cities for sure.
I'm fascinated. I can see one of the tabs there has to do with Sydney. What are your thoughts in terms of the projections and what's happening in Sydney there?
Well, I mean, here's another one again, talking about their housing short. We're seeing a lot of opportunity in Sydney, and every time historically, this again is fundamentally important to bear in mind, when Sydney starts to move, being the financial Australia, it's interesting that within a period of time, the other capital cities start to move. And I'm going to be watching Sydney very carefully. It does have a higher median house price than any other capital, but if things are starting to move there over time, surely but surely, another year, we'll see some things, some movement, and some statistics coming out of Sydney, and then you'll find, as it does historically, the other capital cities will start to move in line with that. So you can just see a little bit there on the National Housing Supply Council, and that's what I was talking about before. Estimates a shortfall of 180,000 properties across the country, and it's also important to know to look beyond, I guess, the media, and to see what all these sort of governing bodies and people in the industry are looking at, and large development companies and so forth, and looking at what they're sort of saying there. We're following those sort of figures because there's a big gap between supply and demand, meaning we can't keep up in that mass market I've discussed. We're getting further and further behind every year, and you can just see a little bit of it touched on there in that article back in April there, that gap's always going to grow, and it's not that simple just to start building another 100,000 properties. That's like building another city. So we have a bit of a crisis that's taking second place, if you like, at the moment behind all this sort of negativity, and that is keeping up with the demand to produce housing in these key areas. And it's interesting, these statistics. The National Housing Supply Council is a government industry, and they're a body, research, and they will release their latest findings, which is very much along the lines with this, very shortly. So you most definitely will get that information. So yeah, I hope I'm making some sense at 3 o'clock in the morning, just to give you a bit of insight in what's really the market here in Australia.
Now tell me, I mean, in terms of, your projections, you've touched on it, but if you had $300,000 to $500,000 $300,000 to $500,000, or even more, if you had up to, $10 million, what would you be focusing on, Richard, based on what you're seeing, hearing on the ground? What is happening, and where are the opportunities at the moment? And then you can probably cover it in the same question, but what would you also avoid? What are the bad things that I shouldn't be getting involved in?
Yeah, look, I think look, you can't go wrong sticking to where there's demand, and there's demand in the capital cities. That's the blue chip stuff. Sure, there's opportunities, and as you touched on right at the beginning, a lot of Australians in real estate will tell you how wonderful their particular area is. They're very good at selling property. But putting all that aside, you look at what makes sense, and the demands in the capital cities. And I think you can't go past places like Sydney, Brisbane and Melbourne. They're our biggest cities, if you like. They've got all the fundamentals behind them. They've got good local economies, strong local economies. They've got major infrastructure going on there to keep up with the future population and where they're going to grow to. And for me, I've always found, for people who certainly Australian investors, if we have people who live in Perth that never go to Brisbane, just like you would probably coming to Australia from South Africa. It's 5.5 hour flight, from Perth to Brisbane. So you've got people that need to follow these sort of patterns and be comfortable with their investment as well, because they don't know the cities across Australia. But I guess where I'm coming from is, if you stick to the major capital cities, I would be looking certainly at Sydney, Melbourne and Brisbane. They've got a lot of things going on there, and a lot of positive information and projects going through, and diverse economies, if you like. Perth's a little bit more orientated towards mining. Adelaide's just, there's a lot of great things that could happen in Adelaide, and if they do, we'll certainly be in there. But the only negative it has is it doesn't have much of a population growth compared to the others. I just recommend that people stay away from things that just don't sound right. It's probably an easy thing to say, but it doesn't sound right to invest way up in the Northern Territory somewhere at the moment, because there may be a new mine. So stick to your major capital cities. You can't go wrong, and look at this long term, like anything, like any major investment, and it will perform. There's no question about that. If you stick to that, I would avoid the temptation to buy investment property in the top end, like a Gold Coast, like a Sunshine Coast we touched on before. Nothing against those areas, they're wonderful areas, but I think for an investor there's better options, as I just touched on, the major capital cities, and obviously that's, as you know, that's what our expertise is in finding these locations within these cities.
And tell me, I mean, with regards to, pinpointing it, one thing you haven't spoken a lot of tonight, which I think is important, is the affordability challenges in the market, Richard.
Yeah, look, I think it's, as anybody can probably guess, I mean, when I talk about the mass market, that's the 75% of our market, if you like, is people, mum and dads, as I've touched on, and it's really their income ratio compared to the debt, if you like. So it's quite comfortable. The average sort of income for Australians, a couple, if you like, is anywhere from sort of $75,000 to $120,000 combined for a family, which can quite comfortably service sort of $400,000 to sort of $450,000. The banks will give you a loan for that, and our banking system is very, very much in line with yours in South Africa. And they're still lending money in that sort of zone, in that area, if you like, because that's where the demand is. So it's about the ability to service that sort of debt, and as I touched on before, wages are increasing and so forth. So the fundamentals are right there with your average household debt, and those are the sort of factors. They're the sort of areas that we look at, and they're obviously large percentages of every sort of capital city. So that's the market that we're following. They're the sort of fundamentals that keep us humming along, if you like, to a certain degree. So Scott, again, I'm not sure if I've answered your question, but the fundamentals there are in that service, that being able to service that debt ratio.
Okay. Is there any more articles that you would like to show, or is it can I move over? And while you're doing that, there's a question here from Chris, and he said, what is better, apartments or entry-level houses for investment?
Look, I think, Chris, it depends on a couple of things. Obviously location and price, and also the yield. Basically the rent you're receiving back from that investment. And there's also, actually, without getting too complicated, it's also to see what's actually happening in that particular area as far as infrastructure growth and so forth, and population. And that's probably where people like ourselves and IPS have got all that sort of information. We tend to handpick the best of the best that we get offered. And yeah, so to answer your question, it would really depend on a couple of those major things there. So it could be either or townhouses, but I would certainly be in that bracket, that market, that 350 to sort of 550 or 600, if you like. But again, depending on several factors.
Okay, fantastic. And then, just in my interest, Kristen's come back with regards to NRAS and said, doesn't NRAS pay approximately $10,000 per year in after-tax money by the government direct to the investor's bank account, as long as the development is an NRAS accredited development?
Yes, absolutely. As long as it's an NRAS approved development, and say a purchaser, even from South Africa, bought an investment property, the government every year at 2 different times of the year would put in a total of $10,000 for the next 10 years as an incentive. So it's $10,000 into your bank account, and I'm talking roughly here because it's all basically CPI as of about 4.5%, so it increases every year on year for the next 10 years. So basically it's a wonderful incentive, but it has to be in the NRAS approved scheme, if you like. And there is a large number of projects that we come across, but we still filter through those because it's still going to have the same fundamentals. But to answer your question, Christian, you're 100% right. It's a wonderful incentive, and backed by the government, it's here to stay. And they've got to produce another, as I said, another 53,000 before approved projects in various cities before the 2013. So there's a lot of pressure on.
Richard, do you mind if I bring the screen back to myself? I just want to show something here on the screen, or is there anything else from your side on your screen?
No, at this stage, Scott, that's fine. Go right ahead.
I just wanted to actually show, you've already gone to it and pointed it out, but I just wanted to show my screen here quickly and just point out some of the parts that I think are very, very important with regards to that RP data article that you showed up. It's actually on the second page. So the bits in yellow are the ones that I just wanted to point out, but higher rates means that the rental market will tighten beyond its already firm levels, with vacancy rates near all-time lows. In turn, this will drive rents and yields even higher. Over the next year, we expect to see wages and disposable incomes continue to rise solidly, while house prices flatline or taper modestly. So, very important for an investor who's looking at the income and that that demand and where the rental demand is going to come from. There was another one here. According to the combined capital cities, and this, Chris, maybe answers your question, medium unit prices are $67,000 or 14% lower than medium house prices. In Canberra and Sydney, the gap between the medium house price and the unit price is more than 20%. With more Australians seeking to live closer to the city and transport nodes, as well as seeking out more affordable housing options, the superior performance of the unit market makes sense. And then the next paragraph, some of the key leading indicators have recently shown improvements suggesting the housing market may be approaching the bottom of the cycle. And then lastly, in conclusion, Mr. Joy, who's the main guy there, says, as a conservative guy, dwelling prices tend to track disposable incomes through the cycle, or the typical owner's average of 7 to 8 year holding period. Historically, disposable incomes have expanded at 6% per annum pace. Going forward, a more realistic guide is probably around 4 to 5% per annum over the next 10 years. It would not be unreasonable to expect to generate this kind of capital growth in concert with rental yields net of cost being 3 to 4% per annum. Patient folks opportunistically investing in housing are probably going to find the best prices and valuation fundamentals, and that they will have had access to in a long time. Otherwise, we favor variable cash rates as an asset class, given the long-held forecast of the RBI will raise rates to deal with Australia's growing inflation problem. Lastly, the Australian housing market demand and supply fundamentals remain healthy, and they will improve further in the year ahead. The one fly in the ointment is interest rates. When the RBA comes to cut them, affordability in this country is likely to be the best we've seen in over a decade, which will help fuel a robust recovery and encourage investors to allocate scarce capital to boosting housing supply. So I think, from a very thorough and well-respected source, it gives a very good indication of what's happening in the market. But Richard, there's a question who's come here through from William, and he said, should I take advantage of the opportunities or should I wait? What are your thoughts on that?
Well, I mean, look, it's the same question we get asked here as well, and of course I'm going to say yes, but I think you'll find that people who get in at this point in time, I mean, look, the mistake is waiting for property to get cheaper, and historically that has never really happened. I mean, yes, at the top end, but in this major part of the market, this is where people need to, the sooner you get in, the sooner you start accumulating all the advantages that you get being an investor in Australia. You get those being a South African and probably more. There are great concessions, there's great tax advantages that accumulate. So the sooner you get in, the sooner you start that 8 to 10 year cycle that people talk about. It's not a mystic figure. I've done it myself by just holding property. And doing it with those right fundamentals that I talked about. So yes, absolutely. The sooner you can get in, of course, the better. There's no point waiting for that middle market to get cheaper, because it's not going to get cheaper. Not with a shortfall, and that shortfall is not going away. So absolutely is the time. Of course, picking the right property. That's what we do, and that's what we can help with. So absolutely. But top end, no, I'd say get on a plane and come over and have a look and spend some time. But no, absolutely, get into as soon as you can and get into that 10-year cycle.
Just to reiterate what Richard's showing you there, the Australian property market is very tax friendly towards property. It's a lot more tax friendly than South African property. So you can actually accumulate the shortfall. So in South Africa, if you've got a property that costs you 10,000 Rand a month and your rent is only 6,000, according to Section 21 of the Tax Act, there's nothing you can do. It's ring fenced. Whereas in Australia, you can accumulate it. You can depreciate on construction. You can depreciate on the fixtures and fittings. You can take an acquisition costs, and even if you want to fly over once a year, you can include it as your inspection costs. So what a lot of clients do is they actually accumulate a great tax loss, and if they ever move to Australia, they don't pay a cent in income tax until they've paid that off. And should they never move to Australia, well, they can offset it against capital gains tax. There's also, it doesn't guarantee you immigration, but it certainly ticks the right boxes, and particularly if you're going on a business visa, it fulfills one of the two criteria that you need to achieve. I know certainly from a credit rating perspective, when I came back from London, I had properties here in South Africa. I had no problem getting car finance, credit cards, cell phones, etc., etc. My uncle moved from Harare to Brisbane, bought a $1.2 million house for cash, and couldn't get car finance, credit cards, or mobile phone for up to a year because he had to establish himself with a credit rating. And then lastly, I think probably the most important thing that what Richard's saying is that if you deal with experts like him who's on the ground, who understands what the opportunities are, it can actually help someone if they're looking to move to Oz at a later stage, actually help them buy their dream home. But for now, you want to focus on investment property where you're getting the best return on your rands and dollars, basically, which I think is absolutely critical. So sorry, Richard, for butting in there, but I just wanted to add these huge advantages of ownership of property that are actually outside of the property market and the cycles, etc., etc.
Fantastic. Yeah. Sorry. So Scott, just to answer your question on whether or not we should be, we're talking to investors about getting in now. Absolutely, as long as the projects are right. I think I touched on that before. And as long as you follow the basics, it's not a lot of rocket science to understand it, but look past a lot of the doom and gloom in the media, because we're seeing investors coming back into it, and provided it's the right property, it is a very good time to be into this market when there's such shortages in rents and shortages in stock across the country, basically in the major capital cities. So, and that's what we'll build. The sort of properties that we'll be bringing on offer, obviously, as we always do to IPS. So yeah, absolutely. Hopefully that answers the question in total.
So in a nutshell, you know, the market is tough at the moment, but there are great opportunities, but you need to have the right people on the ground to be able to suss out those opportunities.
Absolutely, 100%.
And just before, I mean, I can see we're coming up to 8 o'clock there, and I'm sure you want to get back to bed at 4 a.m. in the morning there, Richard, but is there anything else that you think would be of significant importance for, you know, myself or any other investors who are looking at odds in terms of what's happening at the moment?
Yeah, look, I think it's important to point out too, having met a lot of your clients in the past, both in South Africa and out in Australia, and seeing them go through that initial first steps and then investing and then seeing the performance of it and so forth over this period of time, I think it's important to point out how safe a country it is to invest in. There are so many regulations and rules and processes in place to protect an investor. It's a different world in that respect, and I don't mean that negatively. I mean that as in a positive light. As a lot of your South African-based investors have found, I think, and I think you'd agree with me, Scott, with the feedback that we've had over many of your clients. How the process has been that way, and it's in one sort of described them as like it's like purchasing next door. You know, in a lot of respects, that there's systems in place here. There's protections. There's, you know, your money's not going to disappear. The property's always going to be there. It's not like if it was to be built, it's not like it's not going to be built at all. There's regulations. There's safeguards, and I think it's just important to remind people that yes, it's to a certain degree at the end of the earth, but you know, it's a different world. here, and a particularly safe one to invest in.
Yeah, I mean, I think just to reiterate what you're saying there, Richard, two examples. We had, if the one thing with Australia, it drives me absolutely mad when I go there because you can get a $50 fine for jaywalking in Brisbane. So it's a very rules-based society, but as an investor, that's fantastic because you're protected at every level. I mean, we've had clients from a rental perspective that, you're completely protected. And in Queensland, as an example, if someone doesn't pay, 21 days later, they're out. No problems, no questions. It's just the way the system works. And we even had a client down in Melbourne where the building, the quality of the building wasn't up to scratch. Now, very interesting enough, I come from a building background. I saw those photos, and I couldn't see anything wrong with it. But we sent in an independent inspector to make sure that it's up to scratch, and he declared that it wasn't a good enough quality. And the builder actually, without having to get lawyers involved or anything, literally at his cost, chose to replaster the whole building, because if he didn't, he would have lost his license within 3 months, and he was willing to pay for the couple of weeks that the investor would have lost in terms of the rentals. So it just shows you the level of protectionism that is there, and protecting the investor, protecting the investment, and then having people like Richard on the ground who are your eyes and ears and helping you. That's just what makes it such a, I wouldn't say a hassle-free investment, because anyone that's involved in property understands it, but certainly the feedback from our clients is that it's been one of the better experiences they've ever had with regards to property.
Yeah, absolutely. I think it's just important to point out. Like I said, we deal with this every day. I touched on the fact that Perth is a long way from Brisbane, for an example, and you're finding there was an article, I was just trying to find it there, where Australians finally admit they like to invest not just in their local market, but looking at other markets throughout Australia, because it's a big country. There's a lot of distance between cities. And for that very reason too, people are branching out from their own local market. For example, if it was Brisbane, they're looking at Perth if it's a good investment, or Sydney if it's a good investment. So, and they have the same things on their as concerns to them, not being in that area and so forth. But there are many safeguards, including insurances and governing bodies and all that type of thing, which I'm sure you can send the information out to potential people there with those concerns, Scott, as we've done in the past. But,
no, certainly, yeah. Just a quick one. I'm not sure if you can see the screen there, Richard, but just for everyone else, I know you've spoken about it quite a lot tonight, but I just wanted to show the latest research from the RP data and what has happened in the lower end of the market, the middle end of the market, and the most expensive end of the market. So it's what Richard's been talking about, where there was high growth and how the expensive end has fallen off now. And one just has to be so careful. For me, the thing that I've learned, and I know you've mentioned it, but I just want to repeat it because it's so important. You've got to be very careful talking about an Australian market, because there's no such thing as an Australian market. One has to focus on the different cities, because while Sydney can be booming, Perth can be busting, and vice versa. You've got to have people on the ground that understand that. They can understand the fundamentals, they can understand the trends, and then know where the opportunities are. And then secondly, you've got to understand the sectors. I've just shown you this graph here. You've got to know where and why and which sectors to be investing in, because again, there's no such thing as just one market. You can't say the Brisbane market, as an example on this next slide. You can't just say, oh, the Brisbane market's down, and therefore I'm not going to invest in Brisbane, because that's not taking into account all the fundamentals and what's happening. And just because the Gold Coast is being decimated and the Sunshine Coast, which is a bit like saying that Scottsboro on the south coast has taken a hiding, or Plet has taken a hiding, and therefore the whole property market's in trouble. That's not what one needs to. And I'm just reiterating it because I think it's very important, in terms of that, basically. Guys, just something I just wanted to show you. This was a little bit of, a lot of people often get caught up in the short-term trends and what's happening in the market and where it is. I want to show you some research that I did from 1978, which takes into account the South African housing market according to ABSA and the Australian property market according to RP data. And just very interesting, if you invested the exact same amount of money in 1978 in South Africa versus Australia, you would have 3.5 times more money if you'd invested in Australia. So one of the key things with timing as well is that it's not all about property, but it's also about devaluation of the rand and where that's going to go, and whether you think economically the rand will devalue more or whether there'll be political interference to devalue the rand. And it's one of the things in terms of timing that I think is so important, because it's something that's out of our control. So you've got to have the right people on the ground. You've got to do the right research. You've got to find the right property that fits your fundamentals. But you've also got to manage the variables you're in control of. And managing currency devaluation is not something you're in control of. So you've got to look at the properties and make sure and see whether they work. Because you could say, well, I'm going to sit back and wait for 2 or 3 years. And I know certainly just over the last year, clients have made great money based on what has happened, because the rand has already started to devalue against the Australian dollar by nearly a rand or so against the Australian dollar since guys were purchasing a year ago in terms of that market. I've got statistics here, and we've run out of time, but if anyone wants them, on a breakdown between Australia, the UK, and America, the thing that's happening with regards to the debt, the property market, the risk, and then even South Africa, just as comparisons. In terms of where you are, I think going forward in terms of the future, you can make money, but you've got to have great strategies and add real value. You've got to be smarter. You've got to make educated and informed decisions, and you've got to know how to manage your risk and your growth. In terms of investing locally versus offshore, the purpose of tonight is not to go through this, but you can see there the graph, and again, we've got a free report. If you are interested, please get hold of me, and I can tell you the advantages and the disadvantages of local versus offshore investment. So really, in conclusion, 49% of the world's wealth is actually held in property. I love the saying by Jim Rohn: to become financially independent, you must turn part of your income into capital, turn capital into enterprise, turn enterprise into profit, and turn profit into investment, and ultimately turn investment into financial independence. And I know that certainly most people are striving and aiming. I know that I certainly am in terms of what I'm looking for. The very final thing that I wanted to say, it's one of the laws that I've learned. It's the law of nature, but it's basically nature's law that people working together and things working together are a lot more successful. One bird flying on its own versus 25 birds flying in a flock. 25 birds flying in a flock can fly 70% further. And that is why we've got someone like Richard along tonight. It's why we've been working together for the last 4 years. I really believe in globalization. I really believe in investing offshore. But I truly believe you've got to understand the markets, and most importantly, you've got to have best-of-breed partners on the ground. And I really want to say thank you to you, Richard, tonight. It's been a real pleasure having you online. I can hear that it's 3 a.m. in the morning there, and maybe in the future we need to do it during waking hours for you. But thank you so much for your insights in terms of what is actually happening there in the market, because I know certainly for myself and for our clients, it's so valuable for them to know what it is that's actually going on in the market.
Oh, you're welcome. No, it's always been a pleasure, Scott, and it's been a pleasure meeting lots of your clients, both in South Africa and here in Australia. So anytime, if anybody's got any questions, please pass them through to Scott and or information they need. I'm more than happy to do that as we have done successfully. So
Richard, there's just 2 questions here quickly. While I put up the contact details there, if anyone wants to get hold of the team, we can send them all, a lot more information. But there's one question here from Jolene. She said, I've heard there's a 50% concession that one can obtain as a non-resident when purchasing property. Could you just explain that a little bit further for Jolene?
Oh, you mean, sure. No, sorry, yes. I mean, look, that's one of the many advantages you have being offshore. There is a concession on the tax you would pay once you've sold a property. I'll give you a classic example. Using that 10-year cycle scenario, if you bought a property at today's prices of say 400,000, and you sold it for 800,000 in 10 years' time, and historically that's probably where we will be in 10 years' time, but just using that as an example. In Australia, if you were living in Australia here, you would be taxed on the profit there, of the $400,000 profit that you've made. You'd be taxed at the rate that they would tax you at. But as a offshore investor, you automatically get a 50% concession on that taxable amount. So you've made 400,000, so that's the taxable amount, less 50, or take off 50% concession. So your taxable amount is only half that, 200,000. So that's a that's a huge thing for the future. I think that's reason enough for me to get excited about, and absolutely a huge advantage for an offshore investor. And we've got many of those sort of advantages, but I think that's a big one that's not really talked about too much. So yeah, absolutely.
I mean, just in terms of that tax, I mean, we could do another whole webinar just about that, but there's a lot one needs to understand with regards to tax between South Africa and Australia. There is a dual tax agreement. We have mentioned how friendly they are, but thank you very much, Jolene, for asking that question, because it is very pertinent and another advantage of looking at Australia over some other markets.
Sure.
There's one last question here from Pete, Richard, and he said you've spoken about it a few times tonight. His friend is also invested in Australian property, and his friend told him that when he invested in the property, he was told that the Australian property market statistically doubles every 8 years. So his friend has invested roughly 400,000 a couple of years ago, and sort of is expecting that, in that 8-year period to be worth roughly $800,000. And I just wanted, well, Pete basically said, could you give a little bit more clarity on that?
Oh, look, I mean, I think it's quite common knowledge here in Australia that through all the highs and lows, as long as you buy a property and hold it, and it's not something that you've paid over the value of it, like a top-end property or anything like that, if you targeted the right type of market, which we've been speaking about tonight, that's got all the fundamentals behind it. Absolutely, and within that sort of 7 to 10 year turnaround cycle, you're going to see through all the lows and the highs, and we might have 5 years as an example of a low, but sure as eggs are eggs, historically, those prices move with all those fundamentals backing it, with the population and so forth, and our shortages, and over that period of time, if you hold, absolutely, there's no reason why it would go against history and not double in value over that period of time. 7 to 10 years is what we talk about here historically, since they took property records over 150 years ago. That's what we've experienced. I've experienced it myself, and there's no reason why it won't continue, because all the fundamentals remain.
No, well, Richard, thank you very much for your time. Chris Fenton said thanks, Scott and Richard. I mean, it's a real pleasure to have everyone online. Richard, it's a real pleasure to have and hear your insights in terms of what is happening. Guys, we do have a report. It cost us over 50,000 Rand to put together, studying the Australian market. It's a 35-page report which looks into all the risks and what is happening and the returns. It will be updated in the next couple of weeks. I'm due my next trip over to Australia, where I'll be traveling around with Richard and getting the feel in terms of what's happening in the market. We've got cash flows where we take someone through the whole situation so that they can understand the situation, they can understand the capital projections, they can understand the income projections, the yields, the risks, the growth, take everything into account. We've got a report on the 5 things that you need to know before you invest offshore. So there's plenty of information if you want. Richard is constantly feeding us great information on the ground. He's got his eyes and ears open, sniffing out the best opportunities within Australia. But I think, we've run over time a bit tonight, and I think that's all from my side, Richard, and I just want to thank you and everyone else for being online this evening.
No, absolutely. Thank you, everyone, for listening, and it's always a pleasure. So, as I said before, anytime. It's not an issue at all. Thanks. Cool. Thanks so much for listening.
Awesome. Good night, everyone. Have a great evening, and we'll chat to you soon. And you've got all the contact details there, should you want to contact us and the rest of the team. Kristen and Teresa and Richard and myself look forward to assisting you. Good night. Keep well. And here's to wealth preservation, a plan B, and most importantly, peace of mind for you and your family. Good night.